I bring up these topics on the National Real Estate Post, the idea is for other people to use them in order to open up a dialogue with their database. Because oftentimes we have a hard time just calling our past client database up because we don't know exactly how to get to the point, which is, are you going to do something with real estate? Because I want to be a part of it. So let's give ourselves these great icebreakers that actually bring real value to our database.
If the only times that I call you are times when I ask you, who do you know that wants to buy or sell, would you really believe that I have your best interest at heart? Probably not. And so no matter what story I'm telling, you're not believing it. And then I always leave this one for last. This is authenticity.
Hello there, Lab Coats. I am Sean Curley with none other than Mr. Wonderful Brian Stevens with the Real Estate Post. Well, my friend, we have some talking points today, but first thing I always like to get out of the way is if people do not subscribe to your daily show, do not have the mobile app or at least on the email list, they need to go to their app store, type in NREP so you can see Brian's face every day. Giving out some really fun, informative video content, 5-minute chunks at a time. I've been subscribing for almost 15 years now, so I appreciate your efforts, but let's go ahead and roll right into it. So we both experienced the housing crash in 2008 and what led up to that.
Right.
And it was stated income, stated asset loans for the most part, like these crazy ass loan products. Well, Bank of America made some headline news last week about a stated income, stated asset. We don't even care about credit. We're not going to pull credit. We're going to have other measures on looking at the ability of somebody to pay back. Oh, and there's no closing costs, no down payment, but it's only for Black and Hispanic neighborhoods. I don't care what neighborhood it is for. This loan product just scares the hell out of me because it reminds me of back in 2008, whenever we were doing all these state income, stated asset loans and why they didn't perform. So I know you're pretty passionate on this topic.
Well, I've seen this cycle 4 or 5 times now over the past 30 years. This is something that gets rolled out about every 7 or 8 years. The road to hell is paved with good intentions. And I used to think it was that way, but now I just think you're just on the road to hell. Because when you do things, 1, 2, 3, 4, 5 generationally, and it's not just in my lifetime, my lending lifetime, but it's for my parents' lending lifetime. It's a cycle that we keep doing. We offer the riskiest loans to the most at-risk communities in the country. And what do you think is going to happen? Like, for example, I have a 780 credit score and I'm going to put 20% down. I probably couldn't get to a 50 back-end ratio today. However, now let's assume that my debt to income on this, I'm going to get in the weeds here for a second, but let's assume that my back end, I make $300,000 a year. And I have a back end DTI of 50. And, but that means I still have, when you look on a monthly basis, that means I'm pulling in $35,000 a month. And even if, 15,000 of that is going towards my housing payment, it means I still have $15,000 left over for everything else, including deferred maintenance. Mm-hmm. Now, if I make $30,000 a year and I have a 50% back end ratio, okay, that means I'm making $1,800 a month. That means I have $900 in residual income to pay for our car payments, deferred maintenance, your electricity bill, your energy bill, your kids' school lunches, and all those type of things. If I make $300,000 a year with a 50 DTI and my car breaks down, I'm probably going to be okay. If I make $35,000 a year and I have a 50 DTI and I blow a tire, I'm not going to work tomorrow. Mm. Yet they wouldn't give me that loan with a 50 back-end DTI, but they will give it to that person who makes $35,000 a year if they are deemed to be in an at-risk community. That loan is set up to fail. It literally is set up to fail. The only thing worse than not owning a house, my friends, is having a bankruptcy. When you have a bankruptcy, it's going to be even harder to ever get that house if you could own one responsibly. So when we start taking away underwriting guidelines and layers of risk, and that means we are inherently making these loans more risky. Every layer we take away means we get closer to the invariable, the inevitable, which is going to be a default. The worst case scenario for any person, any note holder, any community, it's bad all the way around. So when you have a stated income, it's not stated income necessarily, but they're really not looking at your income. They're not looking at your credit in a traditional sense. They're basically saying, "Hey, are you making your are you paying your phone?" I mean, there's a little built-in inherent nuanced racism in that alone, if you think about it. And they're offering this for primarily, not primarily, exclusively Black and Hispanic communities. So you take away all the layers of risk, which means you just have riskier loans. You offer these to underserved communities that are on the lower, not even the lower, but the lowest socioeconomic rungs that we have in this country. And you provide them home ownership with no real opportunity to succeed. I think this is harmful. I think this is if we're right before the November elections. This is bully pulpiting at the worst that you could possibly get. These loans are going to fail. We've seen it for 60, 70 years right now. It's going to make our hardest hit communities even more hard hit. And it's redlining. It goes against every single thing that we have ever been told in the history of mortgage lending. It goes against the Fair Housing Act. It goes against anything that we're trying to accomplish with HMDA. It goes against the charter of the GSEs. It goes against the charter of the FHA. It goes against the charter of HUD. And everybody is getting on board for this. It's absolutely ridiculous. Take a step back and say, all right, I'm going to only offer loans, 100% loans, greatest rate, no MI, all this great stuff. But you have to be in a white community. And all we're going to do is I want to make sure that one, you own a Bentley, and two, you're making your payment on your Bentley on time. If you're making your payment on your Bentley on time and you live in a white community, we'll give you the greatest loan ever. It's irrational. It's illogical. And yet we're kind of doing the same type of thing. I'm on board with serving underserved communities. I'm on board with serving minority communities because there is a wealth gap that exists. There's a home ownership gap that exists. This doesn't get us any closer to the solution. In fact, the unintended consequence of this product is going to make it even wider. We're going into minority communities and we're giving them loans that essentially have built-in landmines. And what's going to happen is they're going to fail, and these communities are going to, the hardest hit communities are going to pay the consequence collectively, not just the individual, but the communities. When I saw this thing, I actually thought it was a joke. On April Fool's Day, like 15 years ago, I said, hey, click here and you can get a stated income, stated asset, stated value loan. I mean, how stupid is that, right? And then all these lenders clicked it and were like, haha, April Fools. They're like, well, wait a minute, man. I'm like, no, that's so stupid. You have to be smart enough to see how ridiculous that loan product is. You know, those guys. Yet this has the same type of ridiculous April Fool's parameters. It's ill-conceived, and honestly, it leaves me at a loss. I think it leaves everybody who understands this stuff pretty well at a loss.
Yeah, I was kind of scratching my head, and to just back up your point, if you have a loan product for a community and it results in a lot of folks going into foreclosure, not everybody, a lot. Normally those foreclosure homes sell for less, which brings down the comps, brings down the home values, and just basically you're taking 3 steps forward to take maybe a half step forward, or 3 steps back to take a half step forward, in my opinion. But we'll see how it happens. We'll see what goes on with Bank of America because they're rolling it out in a couple communities. We don't know if they're going to go nationwide with it, but we'll stay tuned. Let's switch subjects. So if you live in Florida, you know that insurance is hard to get. You live in California, you know insurance is hard to get because of fires. There was a settlement from PG&E, one of the larger insurance companies out there.
No, it's a utility company.
A utility company, I'm sorry. The utility company got blamed for the fires. Therefore, all of these folks sued the utility company because they lost their homes. Now the utility company has to pay an absorbent amount of money. what is a trickle down effect with this utility company have to pay out? Like, I think something like 55 billion or something.
Oh, it's great. And by the way, I think I saw there's 25 fires in the state of California right now. We just got through a record heat wave out here. And now that the weather has cooled down and you can get out and look around, our skies are starting to fill in with smoke. There's massive fires once again in California. It's a season now. It's not called between summer and fall. You have fire. We have 5 seasons out here.
I'm sorry to laugh, but man, that's just terrible.
It's really true. It's crazy. It's really true. This is every year without exception. When you think about where the most expensive houses are located anywhere in the country, they're by a body of water or they're up in the mountains, right? Well, if you're by a body of water, you're going to get hit with hurricanes, or if you're in a river, you're going to get hit with flooding, or if you're in the mountains, you're going to get hit with fires. Out here in California, you could actually get all 3 of them in one fell swoop. We call that the trifecta.
Plus an earthquake.
So when you look down in not even Southern California, because I don't know if you guys know what Napa is. Napa's a wine region up here. The whole thing burned down. It like 4 years ago. It's 15 miles away from us. Whole thing burned down. And down in Malibu in Southern California, it all burned down. It burns down every year. But here's what happens when you build a house up in the mountains. That means the state of California has to give you a permit to build that house. You can't just build it. The state of California has to give you a permit. PG&E, that's Pacific Gas and Electric. They're a public privately owned company. They are then required to deliver electricity to that property. Well, if you're up in the mountains, up steep cliffs, heavily dense brush area and treed areas, you can't run those lines underground. The only way to run them is to run them above ground. Well, if a branch on a windy day whacks one of these things and hits a transformer, there's going to be a spark. Because we're in a 5,000-year record drought out here, that spark turns into a fire. And then these fires become massive because we have, especially when we're looking at the coastal mountain ranges, you get a ton of wind. That's why you get these huge fires. Well, when you're looking down in Southern California, this is crazy. All these like celebrities, their houses burned down. Who's the Wolverine guy? Hugh Jackman?
Hugh Jackman.
I think him. Like, okay, so his house burns down in Malibu. Hugh's got a nice house down there. Okay. Hugh's house is probably worth, I don't know, $10 million, $20 million. I have no idea. But everybody then goes and sues PG&E and says, it's your fault. No, it's the state of California's fault for giving the permit in the first place. Or maybe it's the industry's fault for not requiring more fire insurance to cover the cost of these fires because you're in an area that's going to burn down every year. No, the state of California decided it's PG&E. It's our utility provider's fault. The utility that everybody in California is required to use. So we sue PG&E, but at the same time we sue PG&E, the state of California says, we'll let you look at your own books because this is public as well. And votes are in here. Remember, votes are in here for the 5 families that have ran California for the past 80 years. Another story. But anyways, they say when you go broke from too many lawsuits, you can then recapitalize by raising the cost of gas and electricity to all the users. So now Hugh's house burns down, his $10 million house. The state of California picks up the bill because PG&E's at fault. PG&E then raises the rates on everybody. And then there's somewhere there's a single mother trying to raise her 2 kids with 3 jobs, working 18 hours a day. She is now going to be offsetting the cost to build multi-million-dollar mansions down in Malibu. This is the reality of California politics and policy. It's the same thing that we have when you look with our national flood insurance policies. Remember when like New Jersey flooded when that hurricane like went way up the eastern seaboard and everything flooded over there, and you started looking at what the actual cost of flood insurance would be for some of these communities, these really, really high cost areas. It was like the policies would come out to like $8,000 a month. That's what you would need to have in order to have reasonable coverage based on the patterns of hurricanes. But you can't have $8,000 flood insurance policies on properties because nobody can buy them. Nobody can sell them. It would create dead zones, wouldn't it? Now that we got all these big, beautiful houses, what are we going to do? We are going to require the taxpayers to pay for these policies on these properties that are in absolute high risk areas. This is one of the problems that we have with all forms of insurance all around the country right now. And frankly, it's crazy. And there needs to be something there needs to be a reasonable solution to this.
Well, I mean, just come up with a reasonable solution and let's start helping our lawmakers. Yeah, it's always fun whenever you look at a house, or if you're looking at a second home or relocating, and you get the price of the house, and then you look at the insurance, you're like, holy hell. And then after you get all that done, especially in California, you start getting your utility bills. Like, well, wait a minute, I didn't know all of this. How am I going to make this? How am I going to swing this? But
well, here's another thing to consider, just real quickly. And anybody, in fact, all lenders and realtors should consider this. We've seen the cost of our properties go through the roof, right?
Yes.
Like, let's say you bought a house 5 yeyears ago. So your hazard insurance policy that you have, it doesn't matter where you can live anywhere. Your hazard insurance policy has got a built-in, it's got an algorithm in there that assumes a level of appreciation and inflation for the cost of replacement. But I want you to think about this algorithm that's been static probably for decades now. And I want you to think of where inflation is at today. So you've owned the house for 5 years. Your hazard insurance policy is going to assume, let's say, the cost of replacement is going to be 3% per year or 2% per year. But inflation is at 9 to 10% per year. That means your hazard insurance policy that you currently have on your house, if your house were to burn down, and that can happen anywhere, and you've owned that house for 5 years, and we look at our current level of inflation, you're going to say, thank God I had insurance on this thing. And your insurance policy is going to come back and say, well, we can build 3/4 of your house because we haven't taken into consideration the actual levels of inflation today, the actual cost of framing wood, the actual cost of sheetrock and a 40-year comp roof or whatever the hell it is you have in here. So as a real estate agent or a lender, I would advise you to go back to your database right now and say, hey, we see how high inflation is right now, and your hazard insurance policy might not take into consideration the exact cost of replacing your house if in the unfortunate event that your house were to burn down. Maybe we should reach back out to your insurance provider and find out if you are adequately covered right now. That would be a great ice-breaking conversation for every lender and realtor to have with their past client database, because the other thing to consider right now is that people in droves are looking at offloading houses for a variety of reasons that we could certainly talk about. People are over leveraged. They can't afford their houses anymore. Inflation is kind of killing people, and some people just want to move. So when you have these type of icebreaker conversations, one, you're bringing real value to your database, and two, it's putting you in front of your database with an icebreaker conversation to see what their and their friends' intentions are with their real estate decisions that they're going to make in the near future, because you want to make sure that you're a part of that.
Yeah, and another topic, not to switch it on you, but while you're touching your SOI in your database, there's a CFPB scam going around.
Yeah.
We just want to let everybody know, just like the IRS, the CFPB will never call you and ask for your bank account information or an authorization code or anything else like that. I don't know, you were talking about this a couple of weeks ago. Like, I don't know how people are still falling for this, and what's unfortunate is the people that are falling for it are most likely going to be the elderly that don't understand how scammers work. And it's terrible, because I think you reported that there was folks that were reaching out to the CFPB that said, hey, I sent you X amount of thousands of dollars and I need it back or whatever. And these poor people, the money's gone. So
yeah, I'm kind of with you on that one. Like, I don't understand how people still fall for this type of stuff, but they do. And I'll tell you this is, like, on the rare occasion when I have somebody, when I get one of these scammers kind of get through to me and I'm talking with them, it stresses me out, because I'm thinking, is there like a 10% chance that like something here is true? Or like, even when you get junk mail, this is from the IRS or this, I'm like, is this real? And so some of that stuff is very malicious in design. And there are people who are falling for this. So essentially what they're doing is they're calling and they're saying, hey, Joe, this is Brian from the Consumer Financial Protection Bureau. There's a class action lawsuit that has been settled with ABC Bank that you were a participant with, and your settlement is going to get you X number of dollars. But in order to process this for you, we need you to send us money first, and then we'll send your settlement money over to you, back to you. And folks are sending this money over, and it's overseas is where it's going. But it is a problem because it's happening to, I mean, who's going to be the most gullible people in the world? My mom, my mom. I mean, don't pick up your phone, mom. My mom would be the one who would do it.
Yeah, my dad as well. And
So-
it's sad. You know, he'd probably still fall for the Iranian prince or whatever. Send me 10,000 to get your 1.2 million. Like, just delete your Gmail, Dad.
I thought it was a Kenyan prince, but
Or whatever.
beside the
Somewhere over there, not here.
But this is again another great icebreaker. Anybody can Google it right now. CFPB fraud scheme statement, and draft an email or draft a bulk text if you have that capability, and saying, hey, there's a scam going around. This is something you might want to talk with your parents about. And oh, by the way, how's everything going with you and you know, with real estate? Whenever I bring up these topics on the National Real Estate Post, the idea is for other people to use them in order to open up a dialogue with their database. Because oftentimes we have a hard time just calling our past client database up because we don't know exactly how to get to the point, which is, are you going to do something with real estate? Because I want to be a part of it. So let's give ourselves these great icebreakers that actually bring real value to our database. And this would be a great one to just draft it. You can put the link in there to the CFPB's statement. You can say, hey, this is going around. Make sure you forward this to mom and dad. You could post it on social media. If you got really ambitious, you could actually even follow it up with a phone call, because real estate transactions are taking place with your database that you are not a part of right now.
For sure. Well, back in the day, we had the 40-year mortgage. It appears that it has come back. Europe has a 50-year, and even Japan has experimented with a 100-year mortgage, which sounds baffling to me. But anyway, I'm assuming the reason why this is just trying to get a payment to affordability, because people realistically, whenever they look at even at a 30-year, I'm never going to pay this thing off. I'm going to pay it down a little bit whenever I sell a cash out, whatever. Are you for it? Are you against it? Or what are your thoughts?
A little bit on the fence. I kind of like how the 40 is designed right now. It's got a 10-year interest only period on it, and then it just goes to a straight 30-year fixed rate loan. And because what it tells me is that loan is designed to succeed. So you have your 10-year interest only, simple interest period for 10 years. And then, you know, the reason it's not a 30-year loan is because then after the 10 years, then you're on a 20-year loan where it goes to a fully amortized and your rate really bumps up. So after your 10-year interest only, which 99% of these loans are going to be gone before that 10-year period anyways. But in the event that your client lives there for a 10-year period, then they just have a standard 30-year fixed rate loan. It's a good deal. But the whole idea conceptually of extending out these loans for a longer period of time is unhealthy, because we're not a culture or society that's really, like you said, thinking about paying off our loans. That's not how we think. Hey, how quickly can I get this thing paid off? We're thinking of, can I afford the payment? Like that's how we're geared. Do you ever bought a car before? You know, it's always, what can I afford? What can I afford? And I think you see like these 72-month loans on cars now, and all this crazy stuff going on. Well, in Japan, this was back in the 1980s when Tokyo was the most expensive real estate in the world. And nobody in Japan could afford to live there, even on the outskirts of Tokyo. So they said, okay, we're going to make a 100-year loan. And what that's going to do is pull the payments down so much that folks are going to be able to have a higher standard of living. And after 20 years of looking at this, 30 years of looking at this, what they discovered was that didn't happen. What happened is, on a 30-year loan, my payment would be $3,000 a month. On a 100-year loan, it would be $1,000 a month. So all they did was bid the houses up to the payment was $3,000 again. That means the $400,000 house of today is going to be a $1.2 million house of tomorrow. So it doesn't make properties more affordable for us. Frankly, it puts them even further out of reach. And what they discovered is they called these generational loans, because those with wealth and great tax attorneys and accountants were using this as a tax safe haven to take their properties and drop them down to their children without having to pay the taxes on the properties. And then of course the poor didn't have the capability of doing this. So what they discovered was, one, no, it didn't increase the standard of living for anyone. Two, it made properties even more expensive. Three, the only ones who succeeded with these things or benefited from them were the wealthy, which is always the case. And it didn't help the underserved communities in Japan. So the idea of conceptually going 40, 50, 60-year loans to bring affordability back to us has a built-in flaw in it that we will not be able to overcome. Unless that is, of course, we mandate that we keep our debt to income ratios down to a point. Maybe you have a 100-year loan, but you have a max DTI, back in DTI of 22 or 18. Then it would work.
Well, we've seen it before, though, especially in the heyday when interest only was huge, is that I can afford the interest only payment. Of course, yeah, I'm going to pay more. I'm going to pay more. But
Right.
then they go out and rack up their credit cards, buy the badass BMW or whatever, and they just overextend themselves because they have a smaller interest only payment on the mortgage.
Right.
That is, and I'm not saying what normally happens, but we've seen it time and time again, compared to where people use it to where it's like, okay, I have the interest only, that's my payment. And if I have a good month, if I'm in sales or if I own my own business, then I can throw a bunch of money at the house and start paying it down a lot quicker.
John?
That hardly ever happens.
John,
So,
it appears since you got your new loan with a lower payment, you've been going to Benihana's 4 nights a week.
yeah.
Is this accurate? Benihana's
Well,
4 nights a
I
week.
have fine dining, sir. I like to spoil myself. So let's talk about the last fun thing to talk about. It's always bankruptcy. I'm being very, very facetious, but bankruptcy rates in August actually increased from August, last month. And, what are the tea leaves whenever you see an August, or whenever you see a bankruptcy filing percentage increase like that?
I high five. I
Yeah.
think it's great. I do. I do. Especially for homeowners.
When you just want more houses to hit the market, get them out.
Yeah.
If you can't pay.
Yeah, actually I do. I do. I do. Yes, I do. Listen, if you're over leveraged and you need to file a bankruptcy, you just file a bankruptcy.
Yeah.
Sell your house first, I mean, what do bankruptcy sell us? And there is a certain level of truth to that. Just what it tells us is what we all see and what we're all feeling right now is everybody is feeling the pinch of inflation. One of the ones that I was looking at, Sean, was these companies, I forget what they were. It's on one of my shows. There's like these 5 companies that basically deliver groceries to your house. But what they do is you're basically buying them on credit. You're buying your groceries on credit. And we've seen folks who are buying groceries on credit from these delivery sites. They've increased like 100% over the past couple of months.
Mhm.
I mean, more people now are buying, Go-Gurt on Cheez-Its and milk and, on credit. I mean, I find that extraordinary. And it's the same canary in the coal mine as bankruptcies right now. Folks are feeling the pinch, but a lot of the bankruptcy thing too is listen, we got to the point where everybody decided, when we weren't working because of COVID, when we started all getting this free money, tons of free money that was coming to everybody. And the workforce, do you realize that, we've got our unemployment numbers are down right now, but did you know that in our post-COVID world, only 50% of the workforce has actually returned to work? There's still a full 50% of our workforce who's not going to return to work. And so for a lot of folks right now who are deciding not to work because they got comfortable at home and decided to start living on credit cards and decided to start, financing milk and eggs. And there just gets to a point to where you're not going to be able to do that in perpetuity. These bankruptcies are going to happen. I just honestly hope that for those who own homes right now and have decided to over leverage themselves, that they speak with a real estate agent and list their house and realize their equity and sell that house to somebody who can't afford it and pay their tax bill, rather than allow the houses to go to foreclosure.
I do believe with a lot of folks, there has to be a big reset on how they look at their financial situation. And, I'll just swipe it today and pay it maybe tomorrow. I don't know.
One of my good friends, Shannon Hoff, she's a loan officer out here in California, an absolutely fantastic loan officer, just baller. She's awesome. Her husband's from France, so they spend 3 months a year over in Europe.
Mhm.
And she goes, Europeans, they don't have credit cards.
Mhm.
I go, what do you mean they don't have credit cards? She goes, they don't have credit cards. I go, they have to have credit cards. She goes, no, they all have debit cards. Nobody's living off of credit in Europe.
Yeah.
And for us, it's that doesn't even make sense.
Yeah. That's
And over leveraging yourself. Listen, when you think about this, like I get pissed off right now. It's like, all right, so a hamburger is going to cost me $18 now. Oh, that's great. A beer is going to cost me $9. My taxes are going to be 8.5%. And on top of that, I have to tip 22 or 25% now. Are you kidding me?
yeah. When's enough?
So now that burger didn't cost me $18. That burger cost me $26 for a hamburger.
Mm-hmm.
And we think this is outrageous, but when you finance that thing and you don't pay it off that next month, that hamburger is going to cost you $500.
Yeah.
That's how you have to look at it.
With the Fed raising with the short-term rates, look at your credit card bills and see what the actual APRs on those things. I saw one that was like almost 25%, and somebody was carrying a balance, and I'm like, you understand what this is doing to you. But anyway, I don't know. It's we always want people to go and earn, but what you're talking about in France is kind of like the depression thinking of, if you can't pay cash for it, you don't buy it, kind of thing. So we'll see if there's a needle that moves a little bit to where people stop doing it. But I don't know. I probably got it. I've been seeing this for a long time. But anyways, that's what I have today. Unless you have something else you want to talk about, Brian.
I will say this is right now. I think a lot of when we start looking at some of the numbers from non-QM loans or non-QM loans and folks who meet the criteria for non-QM loans, self-employed or contract workers, there's 58 million of them in this country. They represent like 28 or 38% of our community. Every small business owner that you know who can't qualify for an agency loan could probably qualify for a non-QM loan. I think right now loan officers need to really understand these bank statement products, DSCR products, and bring these to your real estate agent partners, because if you don't really know about them, they certainly don't. Yeah. But every real estate agent is involved in their community in some way, shape, or form. That's kind of what they do better than anything. So why don't we just tell our real estate agents, you don't need to change what you do over the course of your days, weeks, and months. You can just have more meaningful conversations with all the self-employed people that you run into. Let me tell you about a few of these loan products out there that could possibly help these folks out. Turn your real estate agents into outside account reps. It benefits them. It benefits you. Start reaching out to your realtors, get them together in groups, give them bullet points on non-QM products, and make them outside account reps. Don't look at them as real estate agent partners. Look at them as outside account reps. They'll appreciate the help because everyone's looking for, a marketing advantage right now. And you as a loan officer with these products, you can certainly give this to your realtor partners.
For sure. For sure. All right, man. Well, until next month.
Until next week.
Yeah. Yes, sir. See you later.
All righty, my friend. I'll talk to you soon.
Bye-bye.